basically the Federal Reserve from 2008 to 2016 was encouraging everybody to borrow. I mean, when you keep interest rates so low, corporations are going to borrow as much money as they can because it's inexpensive and it's cheap and it helps their bottom line. And so they did that. They went on a borrowing binge, and now some of that is coming back to roost. And part of it is, potentially over leveraged. Look, it's too much leverage is a matter of a ratio compared to debt to cash flow. And so if you've got plenty of cash flow, like AT&T has $183 billion of debt, perhaps the most debt of any company in the world, but it's also got it's got leverage of 3 to 4 times, so that's probably not that worrisome. Some have argued about GE, which has $115 billion of debt. Steve Tusa at J.P. Morgan Chase has said that it has zero or negative free cash flow. So $115 billion of debt and negative to zero free cash flow is much more problematic. So the question is, companies piled on debt in the last 8 years, and some of that, and why not? Because it was cheap and you get a tax break for doing it. But some of that now is coming home to roost as business plans start to sputter. They've got internal problems. Integrating AT&T, Time Warner together could be a big challenge for a phone company, and that may not work out so well. Next thing you know, you've got $183 billion of debt that you have to pay off. So my point is, it's time to look at some of these things. Is it time to hit the panic button? No, of course not. But it is time to wonder why, my goodness, all this debt that these companies have taken on.
So talk me through, Bill, the analog to the 2007-2008 mortgage-backed securities and mortgage crisis, where it was a small number of defaults in any one of those tranches of mortgages that were bundled together, a very small number that actually caused the whole system to gum up. What would happen if 1 or 2 or a dozen of these issuers of high-yield debt were to default?
Tyler, you've hit on the great point. I mean, Wall Street is a confidence game. Markets are driven by the confidence that investors have in the securities that they're buying. And the moment that confidence goes away, and who knows what triggers it, in 2007 and 2008, it was mortgage-backed securities that weren't paying off, and mortgage-backed securities that had been gummed up on Wall Street balance sheets that they were then used to finance short-term loans. When GE or AT&T goes to refinance some of the debt that it has, and it finds that it can't do it, or finds that it can't do it at rates that are acceptable, rates that are much higher than they're used to, that can trigger a lack of confidence. It was when, if you think back, and I remember when I started on Wall Street at Lazard in 1987, and then in 89 came the debacle involving the UAL going private transaction, when Citigroup said that it could not finance that buyout. That created a 2 to 3 year credit freeze, credit crunch, and basically dried up capital, access to capital for people all over the country. And that was a very, very difficult time. So who knows what's going to trigger the lack of confidence in the markets. But when it happens, capital dries up.
But Bill, there is no doubt that confidence is an integral part of this whole equation. But it's very different to talk about a, say, investment-grade company that's single A, double A, triple A rated in the U.S. and compare them to some of those tranches of collateralized debt obligations during the subprime mortgage crisis. Don't these companies that have some of these higher ratings deserve to have some of that confidence with them, despite the fact that they may have been taking out debt?
But some of those mortgage-backed securities, Dom, had the same very high rating.
But they had tranches that were put together, engineered to have those AAA, AA ratings.
Here's a twist in this whole thing, Bill, and I'm sure you know this as well. I mean, S&P just cut GE's credit rating to BBB+, so it's not too far away from.
Fair enough.
So the real trigger could be, Bill, a big downgrade of the debt by Moody's and or S&P, which would then cause it to move into the junk, which would cause mass selling on the.
You mean technical factors driving fund flows and everything else, right?
Yeah, selling the investment grade.
That thought they were would have to unload
would have to unload
that
debt. I mean,
just like funds that can't own a stock without a dividend. I mean, that's why GE cutting its dividend has been so monumental. I mean, yes, S&P cuts GE's ratings 3 notches. And Dom, I was talking about not the investment grade, obviously, but the BBB, couple of notches up from junk rated debt. That's where AT&T is. That's where GE is. That's where, Keurig Dr. Pepper is. That's where a lot of companies that have taken on a lot of debt in the last 8 to 10 years are, and that's where the risk remains. Now, that risk may be overplayed. There may be risk among smaller credits already in junk land that could trigger this, but there could be a problem. Who knows what triggers these things? But when the trigger comes, confidence is lost, and then the markets freeze up.